Welcome. Today, we're diving into the world of asset allocation, a fundamental principle in investing that can make or break your financial future. Asset allocation is all about how you divide your investments among different asset classes, such as stocks, bonds, and cash. While it sounds simple, many investors fall into common traps that can seriously impact their returns. In this video, we'll explore the most frequent mistakes people make with asset allocation and, more importantly, how to avoid them. Whether you're a beginner or have some experience, understanding these pitfalls is crucial for building a resilient portfolio. Let's get started by understanding what asset allocation really means and why it matters. Asset allocation refers to the process of spreading your investments across various asset classes to balance risk and reward. The main goal is to create a mix that aligns with your financial goals, risk tolerance, and investment horizon. For example, a young investor might have a higher percentage in stocks for growth, while someone nearing retirement might prefer more bonds for stability. The right allocation can help you weather market ups and downs, but the wrong one can expose you to unnecessary risks or limit your potential gains. Understanding this concept is the first step toward avoiding costly mistakes. One of the most common mistakes investors make is ignoring their own risk tolerance. Risk tolerance is your ability and willingness to endure market fluctuations without panicking. If you allocate too much to risky assets like stocks when you're uncomfortable with volatility, you might sell at the worst possible time. On the other hand, being too conservative can mean missing out on growth. It's important to honestly assess how much risk you can handle, both emotionally and financially, before deciding on your asset allocation. This self-awareness is key to sticking with your plan during market turbulence. Another frequent error is chasing past performance. Many investors look at which asset class performed best recently and then shift their money there, hoping for similar results. However, markets are unpredictable, and what worked last year might not work this year. This behavior often leads to buying high and selling low, which erodes returns over time. Instead, focus on a diversified allocation that fits your goals, rather than trying to time the market or predict the next big winner. Remember, consistency and discipline usually outperform short-term chasing. Putting all your eggs in one basket is a classic mistake. Lack of diversification means your portfolio is overly concentrated in one asset class, sector, or even a single stock. This increases your risk significantly. If that area underperforms, your entire portfolio suffers. Diversification helps spread risk and smooth out returns over time. Make sure your asset allocation includes a mix of stocks, bonds, and possibly other assets like real estate or commodities, depending on your goals. A well-diversified portfolio is more resilient to market shocks. Even if you start with a perfect asset allocation, market movements can throw it off balance. For example, if stocks perform well, they may become a larger portion of your portfolio than intended, increasing your risk. Rebalancing means periodically adjusting your holdings to restore your original allocation. This discipline helps you sell high and buy low, maintaining your desired risk level. Forgetting to rebalance can leave you exposed to unintended risks or cause you to miss out on opportunities. Set a schedule like annually or semi-annually to review and rebalance your portfolio. Costs and taxes can quietly eat away at your investment returns. High fees from funds, frequent trading, or not considering tax implications can reduce your gains over time. When choosing investments for your asset allocation, pay attention to expense ratios, trading costs, and how different assets are taxed. Sometimes, a low-cost index fund can outperform a high-fee actively managed fund simply because of lower expenses. Being mindful of costs and taxes helps you keep more of what you earn and makes your asset allocation more effective. Your investment time horizon, the length of time you expect to hold your investments, should play a big role in your asset allocation. If you need your money in a few years, a conservative mix with more bonds and cash may be appropriate. For long-term goals like retirement, you can afford to take more risk with a higher allocation to stocks. Not matching your allocation to your time horizon can lead to unnecessary stress or missed opportunities. Always align your investments with when you'll need the money. Investing can be emotional, especially during market swings. Making decisions based on fear or greed, like selling in a panic or buying into hype, can derail your asset allocation strategy. Emotional reactions often lead to poor timing and increased losses. The best approach is to stick to your plan, even when markets are volatile. Having a clear asset allocation strategy in place helps you stay disciplined and avoid knee-jerk reactions that can hurt your long-term results. Inflation slowly erodes the purchasing power of your money over time. If your asset allocation is too conservative, such as holding too much cash or low-yield bonds, you may not keep up with inflation, causing your real returns to shrink. It's important to include growth assets, like stocks, in your portfolio to help outpace inflation. Balancing safety and growth is key to preserving and growing your wealth in the long run. Some investors believe that more complexity equals better results, but that's rarely the case. Overcomplicating your portfolio with too many funds, exotic assets, or frequent trades can make it harder to manage and track your allocation. Simplicity often leads to better outcomes. Focus on a clear, diversified mix that's easy to monitor and rebalance. Remember, the goal is to achieve your financial objectives, not to impress others with a complicated portfolio. Life doesn't stand still, and neither should your asset allocation. Major life events like marriage, having children, changing jobs, or approaching retirement can all affect your financial goals and risk tolerance. Failing to review and adjust your allocation after such changes can leave your portfolio misaligned with your needs. Make it a habit to revisit your asset allocation whenever you experience a significant life event to ensure your investments still match your situation. It's tempting to follow what everyone else is doing, especially when you hear about hot investments or market trends. However, herd mentality can lead to poor decisions and increased risk. What works for others may not suit your financial goals or risk tolerance. Instead, base your asset allocation on your unique circumstances and long-term objectives. Independent thinking is a valuable asset in investing. Not all assets are created equal. Stocks, bonds, real estate, and commodities each have their own risk and return profiles. Misunderstanding how these asset classes behave can lead to poor allocation choices. For example, assuming all bonds are safe or all stocks are risky oversimplifies reality. Take time to learn about the characteristics of each asset class and how they interact in a portfolio. This knowledge will help you make more informed decisions. Focusing only on your home country's assets can limit your portfolio's growth and increase risk. International diversification allows you to benefit from growth in other economies and reduces the impact of local downturns. While there are risks involved, such as currency fluctuations, the benefits of spreading your investments globally often outweigh the drawbacks. Consider including international stocks or bonds as part of your asset allocation for a more balanced approach. Many investors believe they can predict market movements or pick the next winning asset. Overconfidence can lead to concentrated bets and excessive risk-taking. The reality is that even experts struggle to consistently forecast markets. Instead of trying to outsmart the market, focus on a disciplined asset allocation strategy that doesn't rely on predictions. This approach helps you avoid costly mistakes and keeps your portfolio on track. While stocks and bonds are the core of most portfolios, alternative assets like real estate, commodities, or even private equity can provide additional diversification and potential returns. Neglecting these options may mean missing out on valuable opportunities to reduce risk and enhance performance. However, alternatives come with their own risks and complexities, so research carefully before adding them to your allocation. Without clear financial goals, it's difficult to determine the right asset allocation. Are you saving for retirement, a house, or your child's education? Each goal may require a different approach. Setting specific, measurable objectives helps you choose an allocation that matches your needs and track your progress over time. Take the time to define your goals before building your portfolio. Financial news can be overwhelming and often sensationalized. Reacting to every headline or market event by changing your asset allocation can lead to poor decisions and increased trading costs. Instead, focus on your long-term plan and tune out the noise. Remember, markets have always experienced ups and downs, but a disciplined approach wins in the end. Correlation measures how different assets move in relation to each other. If your portfolio is full of assets that move together, you're not truly diversified. Understanding correlation helps you choose investments that behave differently, reducing overall risk. For example, stocks and bonds often move in opposite directions, providing balance. Pay attention to how your assets interact, not just their individual returns. Manually managing your asset allocation can be time-consuming and prone to emotional errors. Automating your investments through regular contributions and automatic rebalancing helps you stay disciplined and consistent. Many investment platforms offer tools to automate these processes, making it easier to stick to your plan and avoid common mistakes. Employer-sponsored retirement plans, like 401(k)s, often offer valuable benefits, such as matching contributions and tax advantages. Ignoring these options can mean missing out on free money and efficient ways to build your portfolio. Make sure your asset allocation strategy includes your workplace retirement accounts to maximize your overall investment potential. Liquidity refers to how easily you can access your money when needed. If your asset allocation is too heavily weighted toward illiquid assets, like real estate or private equity, you may struggle to cover emergencies or unexpected expenses. Always ensure a portion of your portfolio is in liquid assets, such as cash or short-term bonds, to maintain flexibility and peace of mind. Small, recurring expenses like account maintenance fees or transaction charges can add up over time and eat into your returns. Many investors overlook these costs when setting their asset allocation. Review all fees associated with your investments and look for ways to minimize them. Even small savings can make a big difference over the long run. While many investors prefer to manage their own portfolios, professional advice can be invaluable, especially for complex situations. Financial advisors can help you assess your goals, risk tolerance, and create a tailored asset allocation strategy. Don't hesitate to seek help if you're unsure about your choices or need guidance during major life changes. Behavioral biases like overconfidence, loss aversion, or recency bias can cloud your judgment and lead to poor asset allocation decisions. Being aware of these psychological traps helps you make more rational choices. Consider setting rules or using automation to counteract biases and keep your investment strategy on track. Regularly monitoring your portfolio's performance is essential to ensure your asset allocation is working as intended. Ignoring performance can mean missing signs that your allocation needs adjustment. Set a schedule to review your investments, compare them to your goals, and make changes if necessary. Staying proactive helps you stay on track. Tax-advantaged accounts, like IRAs or 401ks, offer significant benefits for long-term investors. Not using these accounts as part of your asset allocation can mean paying more in taxes than necessary. Take advantage of these options to maximize your after-tax returns and grow your wealth more efficiently. If you're approaching retirement or planning to withdraw funds, your asset allocation should reflect your withdrawal strategy. Not planning ahead can lead to selling assets at a loss or running out of money too soon. Develop a withdrawal plan that balances income needs, risk, and tax efficiency to make your savings last. Reinvesting dividends and interest can significantly boost your returns over time. Failing to reinvest means missing out on the power of compounding. Make sure your asset allocation strategy includes a plan for reinvesting income to maximize growth and reach your financial goals faster. Volatility is a natural part of investing, but not understanding how it affects your asset allocation can lead to poor decisions. Some assets are more volatile than others, and your mix should reflect your comfort level with price swings. Educate yourself on the risks and rewards of each asset class to build a portfolio you can stick with through ups and downs. If you invest internationally, currency fluctuations can impact your returns. Ignoring currency risk can lead to unexpected losses or gains. Consider how currency movements affect your portfolio and whether you need to hedge or diversify further to manage this risk. Personal debt, like credit cards or loans, can affect your investment strategy. High-interest debt should usually be paid off before investing heavily, as the interest costs can outweigh potential investment returns. Factor your debt situation into your asset allocation decisions for a healthier financial foundation. Estate planning ensures your assets are distributed according to your wishes and can have tax implications for your heirs. Not considering estate planning as part of your asset allocation can lead to complications and unnecessary taxes. Work with professionals to integrate estate planning into your overall investment strategy. Insurance can protect your assets from unexpected events, such as illness, disability, or property loss. Failing to consider insurance as part of your overall financial plan can leave you vulnerable. Ensure you have adequate coverage to safeguard your investments and provide peace of mind. Everyone makes mistakes, but failing to learn from them can be costly. Review your past investment decisions and identify what went wrong. Use these lessons to refine your asset allocation strategy and avoid repeating the same errors. Continuous improvement is key to long-term success. Your asset allocation should consider the needs of your family, not just your own. This includes planning for education, healthcare, and other major expenses. Ignoring these needs can lead to financial stress and missed opportunities. Include family considerations in your financial planning for a more holistic approach. Unrealistic expectations about returns can lead to disappointment and poor decisions. Understand that markets fluctuate and that no investment is guaranteed. Set achievable goals based on historical averages and your personal situation. This mindset helps you stay patient and committed to your asset allocation strategy. Markets move in cycles, periods of growth followed by downturns. Ignoring these cycles can lead to poor timing and emotional decisions. While you can't predict exactly when cycles will occur, being aware of them helps you maintain perspective and stick to your long-term asset allocation plan. A written asset allocation plan serves as a roadmap for your investment decisions. Not documenting your plan can lead to inconsistency and confusion, especially during volatile times. Write down your goals, target allocation, and rules for rebalancing. This clarity helps you stay disciplined and focused. Beneficiary designations on retirement accounts and insurance policies can override your will. Not reviewing and updating these designations can result in your assets going to unintended recipients. Make it a habit to check your beneficiaries regularly, especially after major life events. Some investors want their portfolios to reflect their values, such as environmental or social responsibility. Ignoring these preferences can lead to dissatisfaction with your investments. Consider incorporating socially responsible, or ESG, environmental, social, governance, investments into your asset allocation if they align with your beliefs. An emergency fund is a crucial part of any financial plan. Not having enough cash set aside for unexpected expenses can force you to sell investments at a loss. Make sure your asset allocation includes a safety net to cover at least 3 to 6 months of living expenses. Open communication with your family about your asset allocation and financial plans is essential. Not sharing your strategy can lead to confusion or conflict in the future. Make sure your loved ones understand your approach and know where to find important documents if needed. In summary, asset allocation is a powerful tool for managing risk and achieving your financial goals, but only if you avoid these common mistakes. By understanding your risk tolerance, diversifying wisely, rebalancing regularly, and staying disciplined, you can build a strong foundation for long-term success. Remember, investing is a journey, not a sprint. Stay patient, keep learning, and adjust your strategy as your life evolves. Thanks for watching, and here's to your financial well-being.